Um, haven't been doing too many videos this week. I've been a little bit busy. And a little, I don't know, not feeling that great. A little depressed, in other words. I wanted to show a couple goodies here. It seems that some of these high yield ETF people have, I don't know, one of my videos seems to have caused a little stir, and I think people are beginning to notice this, and a lot of these guys are just like, I think I'm going to sell this, or I don't know about this, I don't know about. All of a sudden, they're having second thoughts about their holdings. This is ULTY yield. Here we go, negative 0.78%. Alti. Let's look at another good one. XTT. Let's see. Here we go. 0.43% SEC yield. Nice, huh? Let's see, QDT. Let's see what this QDT 0.41%. The SEC yield. I've noticed a lot of these have gone back to like 3% SEC yield. Here, like, for some reason they're all 3%. They set it up that way, so at least you get a percentage. This is the SEC yield. This is the distribution yield. Basically, it's the refund. It should be called a refund. Or a rebate yield. But they formulated so you get an SEC yield of 3.09 based on the last 30 days. Somebody's going to be left holding the bag. Let me show you. I mean, this is fucking. This is something else here. Look at the 1 year chart on iWimmy. Even though we're in a bull market, this is what this garbage is doing. Look at this. It was at 59. The highest that it went. 69. Wow. And now it's 31. Okay. It's dropped down 45%. And these don't come back. Once it hits like $15 or so, probably by next year, they'll probably announce a split, the reverse split. Reverse splits are, last one out gets holding the bag. This is what a bag holder does. They hold on to their shares until, even though they think that they're getting let's look at this. Previous dividend distributions. It doesn't even show this. Even though they think they're getting a good deal. I did own this. I wasn't pushing for this, but I did own it back in February, right about here, and I just noticed that it's dropping down slowly. No, I'm out of here, and I got out. But we've had last week we kind of broke. We went both ways, and let's see. Well, I'm sorry, guys. I don't know what I'm doing. Yeah, we kind of broke even for the week, and so we're still waiting, still waiting. November is here. Hopefully, we were hoping probably October. Something may come around. We're just in the waiting phase, so I'll just make a video here and there. There's nothing too much that I could talk about more about the grayscale. I'll probably do some videos about some of the things that I've noticed. And I want to actually, I should talk about that now. Okay, let's see. Okay, I wanted to talk about the life insurance and something that we did, just so you know, because this is very powerful, and this is one of those things that make a person wealthy. This is how it's done, guys. Okay. Why? Last February or so, after my mom passed away, she, we had to use the equity, just about 100% of the house, to pay for her caregivers and living expenses, and her medical stuff. And even though she had Medicaid, it doesn't Medicare, but it doesn't provide enough. So a lot of caregiving had to come out of our pockets. She was not insured for long-term medical or assistance. I never knew that type of insurance existed, and it would have been very expensive anyways. But she ended up paying for her healthcare, and came out of her pocket, and some of it came out of my pocket too. So, anyways, we had to get we got a mortgage, right? We got a mortgage for the house, from the house, for the equity on the house. Within 2 years, it was, her equity was pretty much gone after paying for all the caregiving, it's a phenomenal amount of money. Paying for caregivers basically around the clock, even though I was, working for free. I had to take care of my mom. I could take care of her for 8 hours, okay, but after 8 hours, you get tired, and 8 hours is hard. I could do it 10 hours. I could do it 12 hours. And it's hard. It's hard taking care of an older person, especially, she's got to get up every 3 hours to go to the bathroom, or else she gets the infections and this and that, right? There's a lot of this stuff involved. I had no idea that how much is involved taking care of someone, and then taking care of all the paperwork and getting her medicines. And she didn't take too much medicine, but going to the doctors, and the prescriptions, and getting the caregivers to come and help. It's like that's another job. It takes maybe 5 people in order to take care of a person. And she was at home. That's what we wanted, for her to be home, being taken care of at home. Either way, we would have lost the equity probably on the house had we left her in a medical facility, a home for older people. Anyways, we got this mortgage, and she passed away, and then we get the letter from, this was AAG. They call themselves something else now. But, they did what we had. We knew what we each one had to do. We got a letter, and we knew that, the mortgage is due. It's got to be paid, or, we have to leave the house. And, we've been here 40, 50 years or whatever. And it's not easy to just turn around and walk away, especially when you're a little older and you had just gone through a death in the family, it's really hard. It's really tough. You're mourning, and at the same time, you need to clear everything out. Anyways, what ended up happening was my sisters got together, and we came up with a plan. My sister had obtained the whole life insurance about 7 years now. I told her about it. She had looked at some video and she told me about it. Yeah, I told her, yeah, I know about life insurance. It's a phenomenal tool to create wealth. Not just wealth in your later years, but also generational wealth. As I said in my other videos, I knew about whole life insurance when I was 17. Had I bought a policy back then, it's like, oh my God, I'd be fine now. I'd be fine. I wouldn't have to be, looking at the stock market or anything like that. I'd be fine. Anyways, it didn't happen. So I told her, yeah, this is great to get into. Now this is about probably 8 years ago or so. She purchases this life insurance, right? And you can, up front, you can load it with savings, money. And then you designate who is going to inherit the life insurance. But in the meantime, since you are the owner of the life insurance, you can take money out of it. Actually, not take money, but borrow against it for a good investment down the line. And she did that, and I think she loaded up front. I don't remember exactly what it was, maybe 200,000 or so. Plus the benefit, upon her death, her benefit is like, I don't know, maybe 500,000 or so. I forget what she said. We become the beneficiaries, her living relatives of that policy. Now, in the meantime, she can borrow against it. Now, this is the beauty about this thing, guys. It's like, you think this is life insurance and it's boring, and it's like, I don't want to think about it because I'm never going to die, and nothing to do with dying or death or anything like that. But what you can do in the meantime, and this is what rich folks do. This is how these mutual insurance companies got together. It was rich people that got together to guard themselves, to guard their assets. It's very safe. The other advantage is that you can, and what we did was we ended up borrowing $300,000 to be able to pay the $500,000 that we owed AAG, the reverse mortgage company. And she had accumulated enough money from the interest that they pay, anywhere from 13 to 17%, I think at the present moment, but don't quote me on that. But they're paying very good interest. And it's been compounding all this time. What my sister did was take that money out, pays the loan. We pay the loan. We keep the house, where we're at. This is my mom's house, where we're at. Actually, where I'm at, they live out of state. But I don't know, I'm the vampire of the house, I guess. I'm part owner, and I have a small part. But, I take care of the house, basically. and pay the taxes and insurance and heat and light and all that, which I've been able to do it from my portfolio. She gets a letter the other day saying that she is got to pay, I don't know, what was it, 12,000 or 20,000 for the interest that's due on the money that she borrowed. Now, this is what people don't understand, is that money that she borrowed against, it's not that she's taking the money out. I mean, that money stays in that account until it's closed or until it's executed and given to the beneficiaries. That money is there generating income, generating compounded income. After 8-10 years, especially after 10 years, compounding really goes to work. These guys with these ETFs talking about they're compounding their money, and they've only had an account for a couple of years. It's like that's nothing. You don't compound. It takes 10 years for it to really start kicking in, and it's already 8 years have gone by, and they go by fast. And I'm so glad that she did that. And okay, so let's see. So at the same time, okay, try to bear this in mind. She is getting paid something like 45,000, probably 50,000 now for interest on that money that she's got in the account. The money that they lend you is they use the money in the account for as collateral. So she asked for 300,000, and yeah, there's enough collateral here to cover the 300,000. No big contracts, no mortgages, no appraisals, no nothing. Just basically on her signature alone, if you can imagine that. No credit checks. She gets the loan. She got the money. She's got to pay the interest that they charge her, which is very small amounts. I don't know what it is. It may be like 3 or between 3 and 5%. I'm not sure. I don't know at the time, but it's a very nominal amount. It's not, and they don't kill you with fees if you're late one day, and they charge you fees and lawyers and all kinds of things like they do at the bank. She's got to pay that back, but she's getting money from the money she's got loaded or deposited in the life insurance policy. So there's two parts to the life insurance. There's $500,000 upon death that they pay, and there's also the savings, the load, what you put into it initially. There are fees the first 5 years or so, all the way to the first 10 years. They charge you a certain fee, basically kind of like for costs, and then the account just kind of is automatic, and there's no worry. Once you put your money into it, it pays its own interest. And the nice thing about it is that you don't have to pay interest. You do pay interest for the money that they loaned you, but since you got money coming in from compounded money from your savings part, you see there's 3 parts to it. There's the amount that you get upon death, the beneficiary gets. There's the savings amount that you put in initially, or you can do it over a certain amount of years. It all depends. There's different ways to write a contract. There's riders include depending on you, on your circumstances. There's riders that you gotta that are enclosed, that are attributed to the policy, and it all depends on you. And the other part is for instance, if you take out a loan, that loan is separate. It's like, this is what people cannot understand. They cannot understand. How can you borrow against it and you're paying interest and then you got to pay? They don't see it. It's like their money stays in the account. Okay, let's say always. It stays there. You can get a loan on it. 10,000, 20,000, 500. Depends on how much you have upfront, loaded up front. And it keeps generating income. So this is like your own bank that you go in there and tap into it and, hey, let me take out some money, and you can pay it back whenever you want to. That's the beauty about this thing. If you don't want to pay it back, you don't have to pay it back. And that money is still generating on the side. It's working for you 24/7. Okay, I'm going too long on this video, but I just wanted to touch on that. That's what we're doing, guys. And, she's going to be able to pay her interest and still make a little more income from the money that the policy is generating. I mean, she's thrilled to death that she didn't have to come up with more money, and so am I, because I have forgotten about this. And it's like, oh, shoot, no, what more money out of my account, right? So that was the great thing to see these policies work. I'm in the process of getting one, in my first one. I don't know if it's going to be for $5,000, and basically it's just I want to do it to see what has to be done. I want to go through the steps one by one to see how hard, and if it's good for me, which I know it's going to be. I want to see how it works. I want to be in the dirt, so to speak. If I can load it up more initially, that would all the better. And then take that money out and invest it over here in in some of these grayscales, or whatever it is that I think that is better to do. But that is the fantastic thing about it, guys. Think about this. I mentioned in my other videos before, and I always talk when I was like 16 or 17 years old, and I go, this is freaking phenomenal. This is great. And that's why rich people do it. This is how the wealthy get wealthy. Otherwise, we would have to get a loan. Oh my God! And then the interest that we would have to pay, interest, fees, closing costs, the lawyers, points, appraisal reports. What else? Environmental one thing, and they give you a book. It's about, I kid you not, between with this AAG mortgage. When my mom got that, and she was still able to sign her documents, that was about 3 years ago, 4 years ago. I forget. They give you. The application is like 50 pages and 50 signatures for a person that has dementia. That's really hard to do. Oh my God, thinking about this just makes me, how did I survive this? Anyways, and then the application is another a book. It's a book. Are they fucking... This is how crazy things have become. Is this how all mortgages are these days? You gotta write a book. You gotta, and then getting all the paperwork and your get an insurance policy, guys. Get an insurance policy as soon as you can. If it costs you $5,000 a year, that's $5,000 that goes into the account, and it's going to be compounding year after year. After 10 years, these things are phenomenal. And then you can buy another policy if you want. You want to buy a car, right? Buy a policy and then take out a loan from that, and little by little pay it back if you want. They're unbelievable. They're unbelievable. But as soon as people hear life insurance, they get a heart attack. They don't want to listen. Yeah, that's okay. Schemes. Okay, guys. I'll talk to you soon. Maybe tomorrow I'll do a video. I don't know. Hopefully the markets are better tomorrow. We'll see. Bye.